Hello and welcome to Analyzing Finance with Nick. Today I am going to do a viewer favorite, and that is react to a Whatifalthist video because he finally made one again that is kind of in my niche of the world, which is finance. And this one is the dollar doomed? A lot of people have been asking me about what my thoughts are on BRICS and the US dollar and a variety of other topics related to that. It's going to be more structural, long-term talk, more than like trading the dollar index on the 1 year or less time frame, because that's a very different conversation. And without further ado, let's get started. Yeah, the beginning of this video is basically just the explanation that the US dollar is effectively the world's reserve currency, and all countries trade in USD when making national exchanges versus directly in currencies, which is true for the most part. There are some exceptions. The most notable recent one is China and Brazil agreeing to do direct exchange in Brazilian real and renminbi. But the first part that gets interesting is when he starts to comment on his opinion on what this means for the value of the dollar.
They will do so in US dollars. This seems somewhat strange, since it might seem more practical to just trade in the other country's currency. However, everyone involved trusts the value of the US dollar, thus making it the standard. What this results in, however, is the US dollar has a higher value than it probably ought to, just based out of the US's position in the world's economy.
No, that's not necessarily true. Having a reserve currency doesn't de facto make your currency more valuable. And there's a few reasons really for that. First, in order to be the reserve currency, the US has to be a provider of liquidity for the rest of the world. And in order to be a net provider of liquidity for the rest of the world, the US has to be a net importer of goods and have current account deficits. Because every time, let's just say, the balance of trade shrinks in the United States, that usually leads to a crunch in some emerging market country because money is getting tighter. So if the US was not the world's reserve currency, the dollar could arguably be stronger because the US would probably import less and the trade deficit would narrow. Also, there wouldn't be this need to provide global liquidity every time there's a crisis if some other country was willing to do that. And that country would effectively have the reserve currency, or if it was equally divided amongst the world, then that would provide negative pressure on those currencies too. What drives the valuations of currencies is mainly three factors. The first one is relative interest rate differentials in real terms adjusted for inflation. So a country that has higher real rates, currency will strengthen, and one with lower real rates will weaken. The other one is balance of trade. Is your country producing enough more stuff that the rest of the world wants than what you buy from the rest of the world? That should help your currency, and if you have a trade deficit, it hurts your currency. And then the third variable in currency flows is capital investment. Is your country a good place to invest? Usually the rate differential has something to do with that, but if there are other things that are worthwhile to partake in foreign direct investment or in the capital markets apart from interest rates, then foreign investors will more likely invest and keep money in that country than pull it out. Money flows to where it's treated best. And at least two of those three, the US is quite strong right now. The third one, the trade deficit, it's rather weak, but it's not the weakest country in the world in terms of trade deficits. And in addition to that, The U.S. is structurally in a better shape in order to change that if it really wanted to do things such as onshoring and a younger population adjusted for its level of economic development.
The US is a quarter of the world's economy while being around 5% of its population, which means that even if the dollar wasn't the world's reserve currency, it would still mean that it would be a very powerful currency no matter what. However, this means that if a country wants to trade with any other country, and for the vast majority of countries in the world, much, if not most of their economies based off international trade, they have to acquire US dollars. Thus, if Italy wants to buy Saudi oil, they have to do so in US dollars. The world system has accepted this degree of American power since it's easier to have a single currency to base international trade around, but also the US is the most trusted player in the international system.
Yeah, Treasury bonds are much better collateral than any other government or corporate bond, and that is also part of the reason why the system works as well as it does, because just the trust and the credibility of the U.S. as an economic system. Yeah, I mean, the U.S. is still, especially if you're a foreign investor, probably one of the best places to put your money in terms of rule of law and level of opportunities in terms of investment opportunities, and also favorable tax treatment. Maybe not quite as favorable as a Caribbean tax haven, but relatively favorable compared to other developed nations that have high tax rates, and also compared to autocracies where they have capital controls restricting pulling your money in and out. That's the other, again, advantage. The U.S. is, I guess the EU is similar to a degree in this, but the U.S. has the most free environment to pull and place capital, really, of any major country. Like most other countries have heavily restrictions on things such as buying shares in local companies or real estate to protect local citizens, whereas the U.S. really doesn't have any of those things and have a relatively free market to foreign investors. I think that's another big driver of this whole thing.
Although the U.S. may start wars in Iraq or bomb Somalia, it has trustworthy court systems, will police the world's oceans, and so people prefer to play with the U.S.'s currency than other powerful countries such as China or Russia, who will actively use their currencies as a sword to further their national goals, as we'll talk about later.
I think he's overestimating the impact of military here. I mean, that is important, but there are other countries that are able to attract capital that really don't have any sort of power militarily, notably Switzerland and Singapore. It's really just, I think, more to do with how well foreign investors are treated and the liquidity and depth of the capital markets.
Alternately, if a country prints lots of money, the value of their currency goes down.
Yeah, that's true. As long as they're printing their currency at a faster rate that the economy is growing, which generally that is the case when governments print money, because seigniorage is a thing, and when governments want to increase spending and not raise taxes, printing money is kind of the invisible way to take a bigger share of the pie.
What occurred in 1971, however, is that the U.S. moved off the gold standard and had a currency solely backed by faith in the value of the U.S. government, something every other major currency in the world had done around World War I. This also coincided with the high point of state power.
Yeah, see my video that I did of the reaction to Jake Tran's video on 1971 for my full thoughts on the gold standard. And also recommend reading a book called Lords of Finance about what happened in the interwar period that explained how the rest of the world lost its gold standard and the U.S. was kind of the last country to drop it. By definition, really in a technical sense, this is what I'd argue to be the last time the U.S. truly defaulted, was in 71.
Power across all of history. The problem here is that once you remove the heavy metal backing, there's not a tremendous amount of incentive for a government to actually keep their currency real, and it's very difficult for the government to maintain discipline and not burn through their currency.
I mean, there is plenty of incentive to keep your currency real, and that incentive is that inflation historically destroys regimes if it lasts long enough. It was inflation in the Roman Empire which caused the crisis of the 3rd century and a lot of other economic tensions and turnovers of emperors. It was inflation that destroyed the Spanish Empire because they imported too much precious metals from Latin America and it messed up their monetary system. It was inflation that caused the turmoil in the Weimar Germany, and it was inflation that caused the New Deal consensus that emerged after World War II in both political parties in the United States to fall apart with the Reagan Revolution, which was really kind of it wasn't solely this, but high inflation is really kind of the impetus for conservatism in the 80s to rise, because the current system was broken to the people and inflation was kind of the proof of that brokenness.
This has been a problem in the modern United States, which has been abusing its powers as the reserve currency. The US exacts what really amounts to tribute from the rest of the world through the dollar. Countries buy US dollars, and in exchange the world gets protected by the US military. This often works out to be similar to the tribute systems seen in previous...
I don't think this is as good of a deal as Whatifalthist perceives it to be for the US, because those treasuries have to be paid back. Like, buying government bonds is not the same as a direct tribute payment. A direct tribute payment requires no sort of repayment in the future. So yeah, if they were just giving the US grants or sending in investments in companies that were going to likely go to zero, that's more of like a direct tribute payment. But I don't really think it's generosity why these countries buy foreign currency reserves. They buy foreign currency reserves so in the case of they have an economic crisis, they can sell those to preserve the value of their own currency, and also just as a place to hold excess capital that they've gotten through trade surpluses. And a lot of countries have started to diversify away, like 10 years ago, such as China and Russia, which have allocated a lot of their reserves away from treasuries to buying commodities directly. And that started close to the lows of the dollar, or this cycle, about 10 years ago, when the dollar is materially higher than when these countries started diversifying out of treasuries. So what does that say? And then also you have a lot of other countries that have much lower interest rates than the US. That if you are, these all this foreign buying is allowing lower borrowing costs. Well, there are countries with higher deficits, higher debt to GDP, such as Japan and the UK and a lot of the EU countries, and lower interest rates. And the interest rates are more of a local monetary policy phenomenon than a capital flow phenomenon, at least for developed markets. For emerging markets, it's a different story because they rely a lot more on foreign flows to preserve the value of their currency. But yeah, I don't think it's simple as, other countries buy treasuries automatically tribute. And that's why do you think, for example, you had President Trump object to other countries not chipping in to NATO? A lot of this protection is a net cost. If the US pulled out and stopped being the policeman of the world, at least in the short term, it would mean lower government spending, or that military spending being reallocated to social programs, depending on what your side of the aisle views that kind of fiscal policy decision to be, would probably on the net benefit the average American in the short term, but it may create a little bit more geopolitical instability in the long term. So the US benefits from global trade and stability, but they're willing to pay a price for that through defense. And also just if everybody's happy in the liberal international order trading with each other and everybody's rising living standards, it's less likely that a country's going to really be willing to start a war to improve itself if they can improve themselves through peaceful ways such as international trade and global business deals. That's why the U.S. does a lot of its military adventures abroad, is to preserve this order more than being a direct beneficiary of tribute payments in the form of countries buying treasuries.
Where, say, the Romans or Aztecs would get payments from conquered peoples. This works out since if these foreign currencies buy the US dollar, the dollar can be kept artificially higher even when the US prints more money, thus in effect giving America money indirectly through license to have an infinite money press. The thing the US does that annoys other countries the most is that America is the only country in the world that taxes its citizens for income they get outside.
That's not true. There are two other countries that do that. It's Uruguay and Eritrea, I believe, also have that. The U.S. is just the only country that notably has this kind of policy. And yeah, FATCA is annoying. It's annoying for foreign banks, but it's more annoying for Americans who live abroad, because Americans who live abroad in lower tax countries than the United States can't really take advantage of that beyond that's approximately, I think, $110,000 exemption. Otherwise, they gotta pay the IRS no matter where they live, and it's common for a lot of American expatriates who just decide to never move back to the United States to renounce their citizenships because of it. Yeah, I don't really think the rest of the world is. I mean, some countries that have a reputation of bank privacy have had problems with it, like such as Switzerland, but I don't think FATCA is really the main thing that's turning off the rest of the world. In fact, it just more makes Americans living abroad irritated, or foreigners who've moved to America that hold assets abroad and don't want to report them.
Side of America. And because of that, they're constantly going through other countries and barging into their information to see if American citizens in those countries are paying taxes to America. This is the equivalent of, in the 1800s, how the British would police other nations' shipping out on the high seas. This has resulted in the U.S. fining countries like Britain and others billions of dollars for not following American tax laws.
Well, it's not really like that, because when these imperial powers created laws or extraterritoriality policies that basically gave privileges and rights to subjects of the metropole of the empire, privileges over the natives of the colonized lands, they got bonuses and advantages for their status as citizens of the core. Whereas Americans, through FATCA, it's a negative thing. It's not a privilege to have to pay higher taxes because you live in a lower tax country. One is the government abusing its power to favor its citizens, whereas this one, it's the government using its power to just take more money from its citizens for its own gains. This analogy just doesn't hold.
And this is one of the most arrogant things America does in our age, and makes it a lot less sympathetic on the global stage. Another incredibly arrogant thing the Americans do is that for every transaction done in the dollar, whether, let's say, it's between Thailand and Kenya, it's sent through New York City, and thus it goes through American trade law, and so America will fine foreign countries billions of dollars for not following American trade law in a transaction that has nothing to do with America, and spent a millisecond in New York City. This sort of stuff makes other countries despise America.
Yeah, I could see that point, especially if they want to do things in privacy that they don't want the American government to know about. But why should American trade and banking laws apply to two countries that are not geopolitically aligned with the United States or doing any sort of business that doesn't lead to an end product in the United States? I think Whatifalthist has a better argument on this claim than the first one.
This is how the US can have infinite black holes inside its economy, such as its healthcare system, which per capita is at least twice as expensive as the next most costly nation, Switzerland, while not providing that great service.
Well, I think this is a red herring. I don't think the inefficiencies of the healthcare system have anything to do with the US's role in global trade. If it was an advantage to it, then the U.S. healthcare system should be a lot more affordable, and every other country should be more expensive, not the other way around, based on that logic alone. There's a lot of structural issues within the healthcare system, which, as somebody who does not have a background in biotech or medicine, I'm really not the one to comment, but there's certain examples in Obamacare, there's a requirement that insurance companies have to spend 85% of their revenue. And so as a result, these companies will try to spend as much as they can because they have a fixed gross margin effectively. And so in order to make more profits is to expand the overall size of the company, which is the overall spending on healthcare. And that's just one of many perverse incentive structures built into the U.S. healthcare system. And he mentions Switzerland is the second highest in per capita spending on healthcare. Well, those are the only two not socialized medicine countries in the developed world. And those are the ones who finance primarily most of the research for new medicine. Switzerland and America are two of the top companies of pharmaceutical development, of pharmaceutical development. And if it's similar to how the U.S. military spending subsidizes the rest of the world's defense, so a lot of these other countries within the U.S. orbit can afford these generous social programs because they don't have to spend on their military. It's the same with the pharmaceutical industry. The U.S. and Switzerland, to a lesser degree, are the primary funders of research of new medicine, whether through smaller biotech companies or the big pharma companies. And because other countries with socialized medicine aren't willing to pay for newer experimental drugs or ones that are still in their patent life and so without having heavy discounts. And so US consumers have to pay for all of this research through higher prices in the domestic market, so that countries that negotiate harder get a cheaper price. And because they're being we're effectively subsidizing the universal healthcare countries who get to pay less prices for their drugs, for the U.S. consumers paying higher prices for their drugs in order to finance the research. Or often a lot of these times, these countries won't even carry newer, more experimental drugs or medical devices because of cost. And so the healthcare quality goes down. It's not a coincidence why you see the upper classes of most of the world, if they have an important medical procedure, go to the United States to get it done. So it's not really, the flaws of the U.S. healthcare system have nothing to do with reserve currency status or its role in global trade.
Or the US military, which is funded many times over the cost of anyone else in the world. This only barely scratches the surface of bizarre places the US government sends money. Alternately, it puts that money in the economy as stimulus. America has funded its national glut, which has largely indirectly gone into the pockets of wealthy Americans over the last couple decades. This is one of my favorite political memes, and it's where all sides of the political spectrum are looking at the center, where there's a government employee that says, "Money machine go burr," which is actually true, in that the US government prints money as a way to get around actually making hard decisions. Over my short 21-year life, I can't count the amount of times the US government has raised the debt ceiling. The US, although it is the largest economy in
That is true to a certain degree, is that money printing is the can-kick solution to a lot of structural problems. However, interest rates now starting to trend higher instead of lower. The era of hard choices is likely to now come, and we're starting to see it just through this debt ceiling debate. It's just a smaller piece of a bigger pie in terms of you're finally going to have to choose one way or the other of because you can't afford everything if the financing costs through higher interest rates go up. And I've done a lot of this more in previous research papers that I've written about the era of hard choices. But the point being is that demographics, business changes, and higher financing costs means that people just can't, both on the private sector balance sheets and the government, just kick the can by just rolling things over at lower interest rates. People are going to have to make harder choices, and it's going to create more binary outcomes in the economy. It's probably why you see more volatility in the market, and it's also why you see more political polarization, because clear lines in the sand are being drawn now.
History has more debt than its total annual GDP. Until about 5 years ago, with the percent of debt the US has, if it was not one of the most powerful countries in the world, it would be considered a failure. Greece fell apart for a smaller percentage of debt to GDP. The US printed lots of money.
Where is he getting that number? I mean, watch my video on Greece if you want to know the details, but Greece at its peak had over 160% debt to GDP and is still well over 130% debt to GDP, whereas the US's debt to GDP is about 100%. I'll post the exact numbers in a graphic here in this video, but that's just factually not true. And then Japan has 250% debt to GDP. I think a lot of it also, having the current, your own currency helps. Greece was trapped within the euro, and also having a structurally competitive economy also helps, whereas Greece really didn't. It had too much people working in the public sector and heavy dependence on tourism versus more value-added industries. But if you want to know more my thoughts about Greece, watch my video on Greece, which I'll have a link in the description.
For the COVID crisis, but with it, just things went completely insane. We don't have good numbers, but easily 80% of our currency has been printed since the start of COVID. It was true in 2021 that a majority of the currency was printed in the last year since the start of COVID. The US government went through a giant spending glut.
That's not true either. I mean, again, I know I'm referring a lot to my older videos, but I talked about this one too in my video about inflation and the money supply exploding, because Jake Tran 2 years ago made the same claim that almost half the money supply was created since the pandemic, and that is clearly not the case. And I think he's going to elaborate later, because I watched a little bit of this video before recording this about how the fact that you're having record amount of printing, and he did for a while, but money supply is actually going down now. And I will have a chart posted showing that. But yeah, money supply is contracting as a response to this, and that's why we're having a likely recession within the next 12 months.
Or the largest and fastest money printing ever in history. Nothing has been equivalent since World War II. However, the US dollar didn't collapse during COVID. Why? This is since literally everyone else in the world was having the exact same problems and was inflating their currencies at the exact same time to a large degree. Even traditionally frugal players in the world system like Germany or Canada went for full throttle with debt. And
yeah, he's correct on that. I mean, the main bull case for the dollar for a while has been the US has the cleanest dirty shirt. Every country, especially during the pandemic, was printing money, but the US, given the fact that we have a more favorable economic fundamentals and the debts are not as onerous as in other developed nations, that the US has the fiscal capacity to be able to afford to raise interest rates to a level that will actually do something to fight inflation. And that's why the Fed has been so far ahead. Even though they were behind overall, they should have raised interest rates at least a year before they actually did in reaction to the pandemic. But they were well ahead of the EU and the UK and Australia and a lot of these other countries in terms of tightening monetary policy. And that's also why the dollar has been able to just not hold ground but gain ground. And if you've seen the recent CPI prints in the EU and UK, they're having a lot harder time getting inflation down because their governments are more insolvent than the US, particularly countries such as Italy. And so if the EU has a limit, an effective cap that they can raise interest rates to, all countries do. There's a certain point that if the Fed raised interest rates too high, it would risk the solvency of the US government. However, what the advantage of the US is that break point is higher than other developed countries. In places like Japan, it's probably below 2%. In Europe, it's probably below 4%. In the US, the number's probably is over 5%. And these numbers have gone up because of inflation, ironically. With all this inflation that's been going on and the lag, it has been net bad for the populace of the typical American consumer, that the government has benefited from the real value of its debts going down. So if you adjust, especially if you use a more accurate measure of CPI than what the government publishes, the real debt level is adjusted for how much money has been inflated away. The entire COVID boost in government spending has basically been inflated away due to 2 years of historically high inflation. I mean, it's averaged over 7%. The government numbers and the alternative numbers that I provide for my clients show a considerably higher level, not the levels that Whatifalthist is going to claim at later in this level, but still, it's enough that if you compound that against the current government debt, then the fiscal health of the United States looks a lot better. They partially inflated away the problem a lot faster than even I would have expected them to.
People look at the situation is basically every government in the world is trying to weaken their currency. If you have a stronger currency, it makes your goods more expensive for other people to buy, thus making them less attractive on the global market. Global governments are trying to keep their currencies cheaper to keep employment up to maintain their legitimacy or so that they can get reelected. This means that every one of the world's major currencies is in a race to depreciate and weaken their currencies faster than any of the others as to get an edge in global trade. This has been an obsession for the last 20 or so years.
I would say arguably the currency wars peaked really from say like 2010 to 2016. That kind of stretch in time, it was really heavily focused globally on everybody devaluing against each other. Whereas prior to that, and actually now, it's more the focus of countries with weak sovereign balance sheets, or those who need any sort of growth they can get because they can't grow it organically, or emerging markets who just can't normally get capital. Those are the countries that have the incentive to weaken their currencies. Having a weak currency is not necessarily a good thing. In fact, like a strong currency is a sign of economic health. A strong currency, especially if you're a country that imports things such as food and energy, is probably good for a government because it makes basic necessities more affordable. It makes just like in a more globalized society where a lot of goods are just imported anyway, it makes imported goods more affordable and their living standards higher. And also for those who do like to travel, there's the perk that you have cheaper vacations abroad. Exporters, of course, benefit, but they don't all necessarily benefit. What if they import all of their goods for raw materials to make those goods from another country? And if your currency is weaker, you're paying for it through more expensive imports and your component costs. Or a weaker currency also, it may have your employees demand higher wages because the overall cost of living is higher, and so therefore people will not work for below subsistence. So it's not so simple as saying weak currency is good. Weak currency is good if you're a country that's relatively poor and your living standards aren't really dropping that much because they're already rock bottom. Or if you're a country that just has so much sovereign debt to pay off that you need to just have enough nominal growth to keep the engine running. If you're not in one of those two categories, a strong currency is a good thing. Look at Switzerland again, and I keep using them as an example because they kind of buck a lot of these trends. The Swiss franc was 5 to 1 in 1950. It was 1.5 to 1 in the 1990s, and now the Swiss franc is stronger than the US dollar. And has the Swiss economy become a third world country, or has it crashed into oblivion? No, it's doing better than ever outside of some issues with its banking system, which is probably for another video. And the strong currency just increases the local population's living standards. And it's a sign that your country is well managed. So I'm just questioning this idea that weak dollar is always good. On a superficial level for exporters, and if you really have a mercantilist view that trade is a zero-sum game, yeah. But also, even a stronger currency tends to attract capital flows. So you may have a bigger trade deficit, and this is, I think, the thing with the U.S., but the U.S. has the highest level of capital inflows. So if that money's coming back in the form of investment, because people trust that your currency is holding its value, then it's not necessarily just a net loss having a strong currency.
This whole trend gained a lot more steam with the 2008 financial crisis, in which governments were unwilling to admit to their populations that their standard of living had depreciated and thus started printing money to make up the difference. However, that was ineffective.
Yeah, I mean, I'd say that is true. I talked about that in my previous video. Its compensation theory is the idea that the government, through transfer payments or making debt financing cheaper, is compensating for the fact that real incomes are not growing because living standards are dropping. And the worst thing any politician can say, even worse than whatever politically incorrect, cancelable offense there is of the day, is basically saying, look, your living standards are dropping and they have to fall to the level of insert stereotypically poor country that most citizens are aware of in order to be competitive. That is what Jimmy Carter said effectively in the 70s when he told everybody just to cut back and accept a lower quality of life, one of his speeches. And really, no major politician in the United States or developed countries where they have free elections has said anything similar to that since. And for a good reason, because it's politically toxic. So I think he's right about that. It's just they've been trying to paper over, but I think the papering over of lower living standards has been done in other ways other than just devaluing currency.
Even though the American dollar has stayed strong during widespread inflation, inflation overall hurts the poor. For normal people, inflation is basically a tax by the government since they pay more for basic goods and there's no way wages can keep up with it.
I think it's more of a tax on the middle class. The poor are protected through cost of living adjustments to their social welfare payments, or just the fact that there is a welfare state. But for the middle class people who are more self-sufficient and now all their costs are going up and their wages aren't, those are the people who really disproportionately get hit by inflation. The rich benefit if inflation is mild through higher asset prices and asset price appreciation being faster than cost of living increases, but even the rich get hurt by inflation if it gets high enough, as we've seen in the last year in the capital markets. Like the stock market is still well off its highs, and if you adjust it for how much the price level has increased, the stock market is deep into bear market territory. So as I'm recording this, the S&P 500 is at 4,200, and its high was about 4,800 back at the end of 2021. So it's down about 12.5%. The equal weighted S&P 500, if you exclude a few technology stocks that have heavily benefited from the AI boom currently, is down over 20% from its highs and is actually pretty much break even year to date, even though the S&P is up considerably this year. And that's not even factoring in inflation. You had, let's say, 8% inflation using the government's numbers since that point. Well, actually, more than that because it's been a year and a half. Let's just say 8% annualized. So you had about another 12.5% of inflation since that point in terms of the price level increasing. So in real terms, the S&P is down at least 25% from its peaks, depending on how you measure inflation. And if you use equal weighted S&P, or if you use a higher assumption level for inflation, it's down even more than that. And look at what's going on in a lot of private markets. You're seeing venture capital valuations crunching. You're seeing the bond market get hit considerably. That's why a lot of these banks are having problems, because their hold to maturity securities, which are mostly longer duration bonds, have been impaired due to interest rates rising. Private equity, whose valuation is very negatively correlated with interest rates, is hit hard. Look at Blackstone stock, where it's trading at, for example, to see the pain that's in that sector. And then last but not least, real estate. I mean, residential real estate has held up relatively well so far because the market has just been stagnant. People have been unwilling to sell out of low interest rate mortgages. But look at the commercial real estate, it's a different story. You're seeing office buildings in places like San Francisco selling for 80% below its previous valuation. And yeah, and when you have a higher cost of capital through higher interest rates, which is the response, whether the Fed was doing it proactively or the market eventually going to respond, because investors aren't going to accept negative real returns of that magnitude indefinitely. The higher interest rates raise the required rate of return, and that depreciates asset prices. So, and then a lot of these companies' earnings adjusted for inflation are going to go down because the costs are going to go up faster than revenues are. Like even if the earnings are up 5% this year over year, with inflation year over year being at 5% as of today, that's effectively zero. So I think he's wrong that inflation benefits the rich. It may benefit at the beginning when it's rising from a very low level to a moderate level, but once it gets too high, it is very bad for the rich. It's the worst for the middle class because they have really nothing to help them catch up, or a lot less. At least the asset prices will partially catch up. Whereas the poor, they benefit the most because they don't have any money anyway. Their wages on the bottom end will go up because just the market will not clear at a level below subsistence consistently, unless if there's just an extreme, strong, indefinite surge of immigration to keep the labor supply high, but then that would bring down inflation somewhat too. So the lower end of it, because their wages are going to go up the most, and they don't really have any assets or savings that are being eroded, or much of a living standard, a lot less, and then they have social welfare protections, which will increase proportionately to inflation, or at least because they're usually subsidizing a specific thing such as housing or food. And so if those costs go and they go up and they're still covered with those things, then they won't be as hurt as much. And so yeah, it's actually, I think, kind of reverse. Low to moderate inflation benefits the wealthy, whereas high inflation benefits the poor.
Driving down their standard of living. Inflation is supposedly 8% a year, but governments are very good at massaging these numbers for political reasons, and the real ones are what you'll end up paying in a grocery store, or price inflation is much higher, as we can all plainly see. I've personally seen prices rise at 50% for many things, including basic essentials since the start of COVID, and that's something a lot of you can speak to in the comments.
But how many of those things have stayed 50% higher for one? Like, I run alternative inflation data, and at the worst of this cycle, like, it was in the low 20s, and that didn't last for very long. And now, arguably, the real private sector inflation data is actually lower than the government's right now. I think a lot of the inflation data, the flaw of it is that they use lagging indicators such as owner's equivalent rents to show inflation data, and they use sources that are kind of subjective by calling people and saying, oh, how much of the price increased in X, Y, and Z versus using real-time data. So yeah, I mean, I agree that inflation was higher in 2020 and 2021 and 2022 than what the government has said it to be. And it probably structurally has been higher in most up cycles of the economy really since 2000. But these same indicators also underestimate the degree of deflation that happens in down cycles. The worst case scenario really for the real inflation versus the government claim is maybe 50 to 60% higher. So if the government says it's 2%, it maybe really be 3.5 or 3, or if it says it's 4, then maybe really like 6. But like anybody saying, oh, like, well, the government says a print of 5 and it's really like 30, there's really no basis for that. If inflation was really that high every year, we'd have a much higher poverty rate than we do now, and the society just wouldn't really be able to function in a really effective way, and you'd have a lot more capital flight out and a lot more demand for a harder currency to lower inflation rate. Like go to Argentina, that's where you really do have 30, 40, 50% inflation, and they just have to hold all their money in US dollars and spend their paychecks right away. It's a completely different psychology, and just through my living experience and just my analysis of these things, we're not there. But it could come.
Inflation ends up hurting normal people the most since their wages can't keep up with the inflation, while the rich do better since their investments in the stock market are able to fluctuate more wildly. Most stimulus spending eventually ends up in the stock market today, thus pushing that upwards while the rest of the economy goes into decline. In effect, inflation is a tax.
No, it doesn't all go into this. If anything, I think it goes into real estate more than the stock market, particularly residential real estate, because that's seen as an inflation hedge, and that rents just don't go down, even though you're starting to see in some markets they are going down this year, but that's kind of the bias built into things, and it kind of is a doom spiral in the sense because housing costs are the 41% of the basket, then people will demand higher wages to make up for that, and that's where if there is an investor panic because of inflation, it's more likely to be in real estate than stocks. But I mean, what's the mechanism here? The lower cap rates do increase valuations, but when you have inflation, interest rates go up and raise cap rates. So I already explained this. So I don't think it's a given assumption. In the QE era, you did see stock valuations get rather high, because that's when you have the liquidity increase, but it hasn't translated to inflation yet. And then once it actually does translate to real inflation, then it's not such a virtuous cycle for the stock market anymore.
Of the poor for the benefit of the rich. This is why inequality ballooned to such massive levels during COVID, even as the government was giving poor people tremendous amounts of money. For a brief digression, basically everything the government does ends up helping the rich, whether or not that was the intention. Welfare helps the rich since poor people reasonably spend it on things like groceries or clothes, thus going to large companies owned by the rich. Government regulations also make the cost of doing business higher, which is passed off in higher costs, which also hurt the poor the most. Pre-established
I would disagree with this one. The businesses that the poor spend most of their money on basic necessities are not necessarily high margin businesses, and subsidized housing is not a high margin business either for landlords. I think that, however, they are right. He's right about regulation, but it's not regulation doesn't necessarily hurt poor the most. It hurts the middle class who have entrepreneurial ambitions and want to compete with the big companies. And by limiting that competition, one, you increase consumer prices, but two, you prevent new money from entering the system and competing with the old money. I talked about this in my American hierarchy video in my old money series if you want to know more about that. But I think a lot of what he's saying, the poor is the biggest losers, it's really the lower middle class, but the middle class in general.
Interests can afford to get around regulations more easily at the cost of small businesses. America, by all accounts, is in a recession, even though the government has not admitted that it is yet.
Well, I think arguably as we had a recession last year, the first half, and we're at risk of having a second one coming in the second half of this year or in early 24. But if you want to see my first video I did of a reaction of Whatifalthist about another Great Depression, yeah, well, so far that was made about a year and a half ago. Actually a little more, almost 2 years ago. And we're supposed to have something worse than the Great Depression within 3 years, and time's ticking. But if you want my full argument on that one, watch that video. I know I'm referring to a lot of my old videos, but I've tackled a lot of these questions in the past.
World than ever. The second being that China is the first large economy that's strategically independent enough to be able to actually counter America's foreign policy. The Chinese have been talking about leaving the dollar for 15 years. As the US and China's relationship has deteriorated, it gives the Chinese less and less reason to buy into the dollar order that underlies their greatest rival. This sort of coalition could have never formed without the Chinese as their linchpin.
Yeah, I'm not really afraid of the BRICS coalition from an American perspective because, one, China's economy is not really growing to the same degree as it was pre-pandemic. It could arguably be even shrinking. Like, look at this so-called reopening recovery that was hoped upon across the world. It so far has been kind of a bust, where China's economy really hasn't come back as strong as people have hoped since all the pandemic restrictions were removed last fall. They also have a population that's aging faster than the United States and is already, I think, older than the United States, despite being at a fraction of the level of development in terms of GDP per capita. And China, just their whole structure of relying on cheap workers and cheap exports and consistent speculation on their own real estate is starting to unwind. I mean, if you want to know more about that, you should watch my interview I did with Chris Street about the economic future of China. And I think their economic problems are far more severe. And a lot of these countries in this BRICS group are really just ones who are resentful of foreign policy of the U.S. for more strategic reasons than and military reasons than economic ones, particularly Russia and China. And them taking their toys and going home is not really going to threaten the international financial order. I think the only thing that could break the U.S. as a reserve currency is either the U.S. losing a war or having a severe bout of hyperinflation that the rest of the world doesn't happen to go through, or the U.S. goes through a civil war. But even the Romans were able to maintain their reserve currency status of the Civil War. But yeah, I think losing a war or the country's governance breaking down so that it's no longer a friendly place to invest, and I think a civil war would be that kind of catalyst, or just a one-party state emerges in the U.S. that basically erodes a lot of the economic freedom and free flow of capital that has made the U.S. a very trustworthy place to invest money. If that goes away and those fundamentals change, then yeah, you're going to have to see an alternative reserve currency. Will it be the RMB? No, you can't even pull more than 50,000 USD out in a given year in RMB. You need free flow of capital. It'd probably either be some sort of switch back to a gold standard, and whatever country's willing to adopt that, or some sort of new global currency that a lot of other interests in the world agree upon to be the new replacement. I mean, in the euro theoretically could be, but the European Union's fiscal problems are far worse than the U.S., which is why, and their economic fundamentals are not as good either. which is why I don't think that's likely. So I think the US dollar will hold until the US has a permanent impairment in the credibility of its country, or you see a new hard currency emerge and it has to be backed by something real. I don't think Bitcoin really counts on this one. This is probably the most interesting parts of this video, actually, is this chart, the map right here. It shows that basically the US and its most close allies, arguably the quote-unquote American empire, maybe you'd add the Caribbean and Mexico and a few places in South America to this too. But those combined are 3/4 of the world's economy. And if you do add Mexico and a few pieces of closely aligned countries in the Caribbean and South America, and along with Singapore, it could be up to 80% of the world's economy that is in line with the U.S.'s liberal international order. And that is not even factoring the fact that China's economic heft is probably exaggerated due to years of exaggerated growth rates being compounded. So, yeah, that's why I think the BRICS, if they pull out, are not a threat. And Whatifalthist is right about this, and I give him props. This is a pretty good kind of illustration showing that. In the rest of part 3, Whatifalthist really kind of goes into how most of China's allies are really just pariah states that have done something to really offend American foreign policy sensibilities, and they value that and the security of their autocracies over economic growth and rising living standards. And so as a result, they'll do these deals with China, which are on the net probably more unfavorable and resemble more like hard money loans for real estate in the United States than they do with actual like foreign aid. And then when China designs these kind of intentionally to fail, kind of like their own version of Confessions of an Economic Hitman, which I talked about in my Iceberg series, and then try to collect on it through seizing strategic assets such as ports or mineral rights or other things that they wanted to begin with. And the other thing is that all this infrastructure that they build with the money that was borrowed from China, these countries, part of the conditions have to hire Chinese workers to build those infrastructures. So a lot of that money just goes into the wages of Chinese citizens who are building the infrastructure to mainly extract the resources they want out of the country more than actually improve the long-term economic health of these countries. And so when things don't go well anymore and these deals don't work, these countries implode. And they also have the incentive, and use the example of Tanzania here, to just not honor the deal and just turn back and use the threat of turning back into the liberal international order to not honor the contracts with China. So China could risk burning a lot of money doing this. But now let's move on to part 4.
Even though I've painted a decently rosy picture of how it's not likely that the dollar is going to collapse and be replaced, that doesn't mean I'm optimistic about inflation or the global economy in the future. The degree of inflation and money printing that's going on in our current era is unprecedented. Inflation's like drinking, and as said before, there always has to be a hangover. At this point, we're drunk enough that we don't realize how much we're drinking.
Well, we're in the hangover right now. I mean, look at what's going on in the financial markets, and leading indicators in such as ISM manufacturing, non-manufacturing surveys, and PMIs and other things are and retail sales are kind of leading, especially adjusted for inflation, are kind of showing a recession is coming. The one thing that could maybe bail us out is if AI technology just gets adopted at a much faster pace and causes a lot more productivity growth and savings, that might be enough to keep America out of a recession. But the thing is, if a lot of those gains are cutting fat, which is middle class jobs, that's the question really, is the key with AI, is that it could be the opposite. Like right now we're having like a recession with no real losses in employment just due to the way the labor market's structured right now, and the rotation more of overpaid, less productive jobs to moderately paid, more productive jobs is kind of what's been happening, and that's why you haven't seen a big spike in jobless claims. And we switch to AI, where you see massive growth in the economy, but at the expense of more people being laid off because AI is obviating their jobs. What is better? Recession with everybody employed, or economic growth but with massive job losses? Historically, those things aren't supposed to happen. Usually you have job losses when the economy struggles and job gains when the economy does well. But the new dimensions really of the combination of just demographic shifts lowering the working age population on one hand, and AI obviating the labor force maybe even faster than the demographics can catch up, kind of puts us in this weird like twilight zone of economic outcomes that previously weren't possible. Yeah, and the last part he just talks about how every boom ends in a bust, which, yeah, it's mostly true, and I think the bust is just kind of unfolding right now, and about the changing bargaining power of capital and labor, like the heavily unionized post-World War era, where also you had a major drop in production capacity due to Europe's manufacturing base being destroyed by war, and a lot of lives lost in World War I and World War II created a favorable environment for labor, particularly organized labor. And then reforms and to fight the inflation of the 70s and a more freer market kind of reversed that in favor of capital, and also along with the invention of the microchip and software and the internet increasing productivity without people caused capital to take charge from basically 1980 to say 2016, and then political populism now, along with the retiring of the baby boomers and smaller generations replacing them and just tighter immigration policies, now switched it back to labor, and that trend would continue probably for a similar long cycle if it wasn't for AI, which I mentioned earlier in this video, could kind of shift things back in favor of capital a lot quicker than people expect. But yeah, overall, this is an interesting video. Even though him and I have a different view of how things work and the mechanics of why things are going the way, we come to the same conclusion that the dollar is likely not doomed. I mean, the dollar probably could see a correction, maybe down to 70 on the dollar index, the next down cycle of the USD, but I don't really see anything that would break it short of the US losing a major geopolitical conflict internationally, or the domestic institutions and rule of law creating to the point where foreign investors no longer trust the United States as a place to store capital. I haven't seen enough evidence of either of those things happening soon enough for me to be concerned. However, I will let my viewers know when that happens. This was quite a bit of a long reaction, but thanks for coming along with me on this ride, and feel free to like and subscribe and comment if you want me to do more reactions like this, and I'd like to know what your thoughts are. Thanks for watching.